Hi, my name's Eric. I'll be reading you Barrons magazine with an issue date of April 28th of 2025. This recording is produced by the Audible Local Ledger, a reading service for people who are blind or print disabled exclusively. We'll start with the first column, Up and Down Wall Street. Time is running out for stocks. Trump's next move is crucial, by Ben Levison. The waiting is the hardest part. Whether it's waiting for a delayed flight, to find out if we got that new job, or to see if we won the lottery, long periods of uncertainty are difficult to indulge. There's a desire to do something. Have a stiff drink, send one too many follow-ups, or spend money we don't have. To make time go faster, and to tamp down the anxiety that comes when faced with the unknown. The stock market finds itself in that position now, waiting to see whether President Donald Trump's tariff policy will cause a recession or whether the U.S. can still emerge relatively unscathed. Thankfully, the near certainty of doom that seemed apparent just a couple of weeks ago has faded after Trump blinked on tariffs. After gaining 4.6% this past week, the S&P 500 index has now climbed 11% from its April 8th closing low. And the temptation is to consider the worst over. Resist that temptation. Sure, it's easy to imagine a bull case, even a long-term one. The president, who this past week said tariffs on China will come down substantially, has bought himself time to work out one-on-one deals with countries across the globe. And just one deal, any deal, could cause markets to jump. His deal-making could also push other countries to strike deals with one another. The result could be a world that hasn't deglobalized, but just reordered itself, as Jawad Mian writes in his Stray Reflections newsletter. Adding to the case for upside, tech stocks finally showed signs of life this past week. ServiceNow jumped 21%, Texas Instruments gained more than 9%, and even Alphabet rose 7.7%, helped by its own results. Good news, given the underperformance of the Magnificent Seven since the DeepSeek sell-off began near the end of January. Yet the bear case seems just as reasonable. While Trump has dialed back the tariff rhetoric, the next Truth Social post could send stocks lower, and investors are still waiting to see what damage has already been done by the will he or won't he nature of trade policy. The hard data have held up well because the penalties haven't started yet. And that'll probably be true for first quarter gross domestic product to be released on April 30th and April's payrolls report on May 2nd. That has investors eyeing May's or June's results for the first sense of the damage done. It could go either way. Polymarket puts the chances of a U.S. recession at 55%. That seems about right, which means picking a direction, either direction, is probably no better than a coin flip. In the very short term, the equity pain trade likely remains to the upside as the market prepositions on tariff de-escalation, writes J.P. Morgan strategist Dubravko Lakos-Buhas. However, as the summer approaches, we could start to see some softness in activity due to aggressive tariff-related front-loading, lagged effects of other policies, and lower business investment activity. In other words, tariffs still loom. While the 145% penalty on Chinese goods is unlikely to hold, Trump himself has floated a rate that could be 50 to 65%, as Evercore ISI strategist Julian Emanuel notes. Combined with 10% levies on the rest of the world, that would average out to about 17.5% at its midpoint by year end. That would put the S&P 500 at 5,600, or up 1.3% from Friday's close of 5525.21. But Emanuel expects the market to remain range-bound for a while. The decline in trade policy uncertainty from parabolic to merely extraordinarily elevated is priced in, he writes, which sets up the S&P 500 to trade in a range of 5,100 to 5,600 until or unless concrete policy news emerges. A retest could come soon. 22V Research's Dennis DeBuscher predicts that the market wants to see an aggressive reduction in Chinese tariffs, or it's likely to test the Trump administration again. The good news is that the economy was solid before the trade war started, and first quarter corporate earnings have held up well. If tariffs come down quickly, the U.S. economy should be able to avoid the worst. But if not, a reduction in China tariffs is needed quickly, DeBuscher writes. Otherwise, tariffs will come down the hard way after a recession starts. Maybe the wait won't be so long after all. For investors, food stocks have been as appetizing as a plate full of slugs. And no, it isn't about RFK Jr. On Wednesday, Health and Human Services Secretary Robert F. Kennedy Jr. announced the phase-out of 8 dyes commonly used in U.S. foods, something that companies should have and probably did see coming. Yes, we love the rainbow of colors in a bag of Skittles or the blinding brightness of our Trix cereal, but when even my 14-year-old son checks ingredients and avoids artificial colors and flavors, you know it's time to move on. The companies which haven't pushed back against the rule probably know it. But their troubles go well beyond their use of dyes. There's more from Kennedy. He also wants to make soft drinks and snacks ineligible for the Supplemental Nutrition Assistance Program known as SNAP, while Ozempic and other weight loss drugs have hit snacking too. So has the proliferation of fitness trackers and calorie counting and ingredient checking apps. Big food companies also raised prices more than they needed to during the pandemic, and consumers are looking for cheaper and healthier alternatives, says TD Cowen analyst Robert Moskow. Some of these headwinds are reflected in food stocks, which dropped 8.7% over the past 12 months, while the S&P 500 rose 11%. And while food stocks have outperformed so far this year, the S&P 500 Food Products Index has returned 0.1% to the S&P 500's 5.7% loss. They've underperformed the consumer staples sector 5.1% rise. Many prominent companies, including PepsiCo, Conagra Brands, Campbell's, and General Mills, have suffered nearly as much as or even more than the market. Worse still, they probably won't recover their previous haven status without major changes, Moskow writes. What should food companies do? Boost the perception of quality, upgrade the product, or cut the price, according to Moskow. Campbell's should improve the quality of its soups, prepare for price cuts, and consider unloading its V8 brand, while General Mills should cut prices and focus on product quality in its advertising. Kraft Heinz needs to invest in higher quality, especially in products like Lunchables, Capri Sun, and mac and cheese, where the company has lost share as customers pivoted to healthier options, he writes. Taking such steps will be far from painless, but making changes at the margins doesn't seem to be helping either. PepsiCo stock fell to its lowest level in 4 years this past Thursday after the company missed earnings forecasts and lowered its full-year guidance. Comments about phasing out dyes and offering more price points didn't seem to appease investors. Making big changes doesn't have to lead to disaster. RBC analyst Nick Modi points to Constellation Brands, which cut its medium-term outlook earlier in April on concerns about tariffs and industry pressures. The stock rose 0.7% even as the S&P 500 fell 3.5%. We believe investors are of the view that the company took down its numbers enough so as to provide a buffer even if things deteriorate further, writes Modi, who counts the stock as one of his top picks. Just don't expect the safety that food stocks once offered. If most gaming companies are playing checkers, Duolingo is playing chess, literally. The company, known for its language games that teach users Spanish, French, German, Japanese, Korean, and Chinese, among others, announced this past week that it had launched a new offering in beta form, Chess. It's the app's first new addition since it added math and music in 2023. While some might see chess as an egghead pursuit, it has an enormous following. While data are hard to come by, D.A. Davidson analyst Wyatt Swanson estimates that some 690 million people play the game, while the website chess.com has 210 million registered users. What separates Duolingo's offering from others is its focus on teaching people how to play the game, not just offering them a place to compete. If all goes well, chess could bring in $60 to $150 million in total bookings in 2026. Swanson rates the stock a buy, with a $410 price target, up 7.4% from Friday's close of $381.83. Duolingo doesn't need chess to succeed, however. When Morgan Stanley analyst Nathan Feather initiated coverage of the stock with an overweight rating on Wednesday, he played down the company's offerings outside its core language games. Language learning is 4 times as large as music, which is the follow-up category, and Feather refers to the non-core offerings as call options, bets that could pay off, but where success isn't the base case. That didn't stop him from initiating the stock with a street-high $435 price target, and the possibility of $530 if everything goes right. The list of reasons for optimism is long. They include a large total addressable market, one big enough to boost revenue by 26% annually over the next 5 years, margins that could increase to 40% by 2029, with an outside chance of reaching 50%, and the fact that it's a beneficiary of artificial intelligence with its generative AI-based Max tier. With the stock about 30% off the high, despite no tariff risk or history of macro sensitivity, we see this as a compelling entry point, he writes. Perhaps a little less compelling now. Duolingo's stock jumped 10% on Wednesday, and the stock finished the week down just 13% from its February high, though it still has 14% upside to Feather's $435 target. If the bull case plays out, it would be a 39% gain. Given market volatility, there's a good chance that investors will get another dip to buy, especially as Duolingo's earnings on May 1st approach. Duolingo isn't playing games, and its stock is one to watch. From the review and preview section of Barrons for April 28th. The Vatican as investor. One legacy of Pope Francis, who died this past Monday at 88, will be financial. The Vatican's investments have been profiting from a renewed focus, led by the pontiff, on social values aligned with the Catholic Church. In 2023, the administration of the Patrimony of the Apostolic See, or APSA, made nearly 46 million euros, $52 million from its investments. 37.9 million euros covered church expenses, and the rest was profit. APSA invests in international and fixed income securities and provides the church consulting, financial solutions, and access to capital markets. Profits rose more than 40% from 2022, when the church outlined faith-based measures for Catholic investors, eschewing abortion and birth control, pornography, excessive use of alcohol and other addictive substances, weapons, capital punishment, and mining. Many of the factors of ESG resonate with its aims, the church said. APSA doesn't list specific holdings, but the global ex-S&P 500 Catholic Values Exchange Traded Fund, which also excludes companies involved in activities perceived to be inconsistent with Catholic values, resembles an S&P 500 fund. Apple, Microsoft, and Nvidia are top holdings. In 2022, APSA lost more than 6 million euros on its investments. It noted that 2023 maintained a proper balance between risk and medium to long-term profitability. The 2024 report won't be out until summer. That was written by Paul R. LaMonica. In the review and preview of last week in the markets, the week began as President Donald Trump again attacked Federal Reserve Chair Jerome Powell. sending the S&P 500 down 2.7%. The dollar sank, and gold, Bitcoin, the yen, and the euro rose. Trump walked back his Powell attacks, and Treasury Secretary Scott Bessent admitted the China-U.S. trade war had to end in the very near future. Stocks rose on the seeming thaw and talk of Fed rate cuts, and then wavered as China denied talks were taking place. On the week, the Dow rose 2.5%, the S&P 4.6%, and the Nasdaq Composite, 6.7%. In companies last week, Harvard sued the federal government and is in talks to sell $1 billion in private equity stakes. Tesla's quarterly profits fell 71%, and Elon Musk said he would return to the company in May. Bullish signals from the Food and Drug Administration ignited a biotech rally. Intel said it would cut its workforce by over 20%. Swiss-based Roche and Novartis both announced big U.S. investments. The European Union fined Apple $571 million and Meta Platforms $228 million for antitrust violations. Apple accelerated its India iPhone production shift. Boeing reported a lower-than-expected loss, but a China shutdown loomed. Alphabet's profits rose 46%. In deals last week, the Financial Times reported Chinese state funds have been pulling out of U.S. private equity firms. Bank regulators approved Capital One Financial's $35 billion merger with Discover Financial. And Bloomberg reported that Rite Aid is looking to liquidate as it nears a second bankruptcy. In this week of the review and preview section, on Tuesday, April 29th, we enter the heart of earnings season with roughly a third of S&P 500 index companies reporting. That's the busiest week on the first quarter earnings calendar. Coca-Cola and Visa announce earnings on Tuesday. It'll be followed by Meta Platforms and Microsoft on Wednesday. Amazon.com, Apple, Eli Lilly, and MasterCard release results on Thursday, while Chevron and ExxonMobil close out the week on Friday. On Wednesday, April 30th, the Bureau of Economic Analysis releases the Personal Consumption Expenditures Price Index for March. Consensus estimate is for a 2.2% year-over-year increase, 0.3 of a percentage point less than in February. The core PCE price index, which strips out volatile food and energy prices, is seen rising 2.6%, compared with 2.8% previously. If the Federal Reserve's favored inflation gauge, the core PCE, comes in as expected, it would be the lowest annual reading since March of 2021. And on Friday, May 2nd, the Bureau of Labor Statistics releases the jobs report for April. Economists forecast a 130,000 gain in non-farm payrolls after a 228,000 increase in February. The unemployment rate is expected to remain unchanged at 4.2%. By the numbers, $130 billion. The U.S. financial services trade surplus with the world in 2024, threatened by a global trade war. 3,521%. The U.S. tariff on solar panels made in Cambodia, the biggest of the duties on 4 Southeast Asian nations. 23%. The increase in Chinese auto exports in 2024, or 6.4 million cars, over 50% higher than number 2, Japan. And 3.6 million U.S. births in 2024, up 1% over 2023, but still below the replacement level of 2.1 births per woman. Cover story is a little earlier in the magazine than usual. How Berkshire is shooting out the lights. Warren Buffett's company is bucking the downturn heading into its annual meeting. Is its stock too pricey? By Andrew Barry. Warren Buffett's Berkshire Hathaway is trouncing the stock market this year, which makes the company's annual meeting in Omaha on May 3rd a celebration of 60 years of good fortune, but also a moment to reflect on what's still to come. Buffett's star has never burned brighter. Few companies have created more wealth for individual investors than Berkshire, with many long-term holders sitting on stock worth $100 million or more. The Class A shares, now around $795,000 and near a record, are up 40,000-fold from around $20 in 1965, when Buffett took control of a struggling textile company and began his run as Berkshire's leader. Berkshire has stood out in a year when many are moaning about losses in their equity portfolios. The stock is up 17%, besting the S&P 500 by 23 points. That's the widest margin since 2007. Buffett's decision to build a war chest of more than $300 billion of cash and equivalents, the most of any U.S. company, by selling a net $134 billion of stocks last year, mostly Apple shares, now looks prescient. Yet investors may be feeling some unease given Buffett's age. He turns 95 in August. Buffett told shareholders in his annual letter in February that it won't be long before his likely successor, Berkshire executive Greg Abel, replaces him as CEO. Few companies are more closely associated with their chief executive than Buffett, and that's a risk for investors. He's the most iconic CEO in the history of CEOs, says KBW analyst Meyer Shields. A lot of investors own the stock because of Warren Buffett. Still, now seems like an inopportune moment to chase Berkshire stock. It looks richly valued relative to its history, and it shows little sign that investors are worried the company will lose some of its magic without Buffett at the helm. The Class A shares trade for 1.7 times book value, their highest ratio since 2007, and for 25 times projected 2025 earnings, a larger than usual premium to the S&P 500, which fetches about 20 times. What's more, analysts see little earnings growth this year or next. The stock also trades at or above what some analysts and investors estimate to be the company's intrinsic value, essentially a sum of the parts valuation favored by Buffett versus a meaningful discount in recent years. Berkshire now fetches a slight premium to the estimate of intrinsic value published by investor Semper Augustus Investments' Chris Bloomstrand, who owns the stock, against a 25% discount in early 2024 and a 10% premium to UBS analyst Brian Meredith's estimate. Buffett, too, may view the stock as overpriced. Berkshire hasn't repurchased shares from May 2024 through early March, the latest date for which there's disclosure. That compares with buybacks of over $24 billion annually in 2020 and 2021 when the stock traded for as little as book value. Berkshire's extended valuation could mean that in the next few years, the stock will underperform the S&P 500, the benchmark to which Buffett regularly compares Berkshire stock. Though the stock doesn't look cheap, the giant conglomerate has never been in better financial shape. Not only was Berkshire sitting on $318 billion in cash at the end of 2024, but its operating earnings, excluding investment gains, are running at more than $45 billion annually after taxes. Berkshire's market value of $1.2 trillion, behind only Apple, Microsoft, Nvidia, Alphabet, Amazon.com, and Meta Platforms, suggests it, not Tesla, should be part of the Magnificent Seven. At the annual meeting, Buffett will share the stage with Abel and insurance chief Ajit Jain, answering shareholder questions for 4.5 hours on a range of topics. Investors will get less time with him than in the past. Buffett has cut back the length of the Q&A segment by about an hour relative to last year, perhaps in a concession to age, and will end shareholder questions at 1 p.m. local time rather than later in the afternoon. Even so, investors will be watching him closely. He has sharply reduced his public appearances in recent years, and the annual meeting is the only time that investors get to hear from him at any length and see how he's faring with their own eyes. Catherine Seifert, an analyst at CFRA, says investors will be interested in Buffett's view on Berkshire, tariffs, and the economy, as well as qualitative elements. How is he doing, and what's his demeanor? The questions are apt to come fast and furious, starting with the direction of the company after Buffett steps aside. Abel, who headed Berkshire's utility business before taking on his current role in 2018, has been running Berkshire's non-insurance business on a day-to-day basis. He's earned praise from Buffett, who says Abel takes a more hands-on approach and is getting better results from the company's 100-plus subsidiaries. Buffett was a hands-off manager, famous for simple, one-page employment contracts with Berkshire's operating chiefs. While Abel is likely to be CEO, Buffett's children, Howard, Susan, and Peter, could play outsized roles in the future of the company. They'll control the trust, holding Warren Buffett's stock after his death, and they will wield considerable power. Howard, now a board member, is likely to become chairman, and Susan, now on the board, probably will remain a director. Buffett's stake is now 14% of the company on an economic basis, but he has 30% of the voting rights due to his ownership of the super-voting Class A stock. That stake is falling slightly each year as Buffett gives away shares. The family's influence will diminish over time after Buffett's death as stock is donated to various philanthropies over more than a decade based on Buffett's stated wishes. But his children will exercise considerable influence during the initial years after Buffett's death. One thing the children are likely to resist is a breakup of the company, something Buffett opposes and fears might happen after his death. Buffett believes there are benefits to the conglomerate structure. There also could be management changes after Buffett leaves the scene. Jain, now 73, could depart and possibly be replaced by Joe Brandon, a Berkshire insurance executive who was head of Allegheny before Berkshire bought the company in 2022. Investment managers Todd Combs and Ted Weschler, who now run about 10% of Berkshire's $300 billion equity portfolio, could take over the whole thing. It remains to be seen which role Abel will play with the equity portfolio. Investors might also be curious about whether Berkshire will pay a dividend after Buffett departs. Buffett has long opposed one, arguing that the company's earnings and cash are better in his hands. That has been fine with the Berkshire faithful, but the policy will probably change once Buffett departs. Large, highly profitable companies, including former holdouts Alphabet and Meta Platforms, invariably do pay dividends, and it'll be harder for Abel to resist. It would be a great way to show leadership without changing the culture, says KBW's Shields. A dividend would also take some pressure off Abel to invest Berkshire's ample earnings. Other shareholders will have more immediate concerns, such as whether Berkshire has taken advantage of recent stock market turmoil to invest a chunk of the $300 billion plus in cash, more than the value of the stocks in its portfolio. Many would like to see a repeat of the 2022 meeting, when Buffett revealed about $50 billion of buys early that year, including Occidental Petroleum and Chevron. Shields thinks investors looking for big Berkshire buys may be disappointed. Aside from a brief period in 2022, Buffett's been cautious on new investments over the past 5 years, and Berkshire has been a net seller of stocks in 4 of the past 5 years. The large cash buffer serves another purpose. It would give Abel the ability to buy back a lot of stock if the shares tumble on Buffett's exit. Buffett may be building so much cash in anticipation of the management transition, Shields says. Investors hoping that Buffett lands what he called an elephant-size acquisition in the coming years may also be disappointed. Berkshire hasn't made a major deal since 2016, when it overpaid to purchase aircraft parts maker Precision Castparts for about $34 billion, and that acquisition has been a big disappointment. The company was hit hard during COVID, and its revenue is barely back to where it stood a decade ago. Precision might now be worth what Berkshire paid for it, while the S&P 500 has tripled over the same period. Berkshire's purchase of truck stop operator Pilot companies in 3 stages from 2017 to 2024 for $13 billion looks good. Not great, with Pilot's pre-tax earnings down 42% to $614 million last year. Still, it's possible that Buffett changes his mind and seeks to buy the remaining 72% of Occidental Petroleum that it doesn't own now. Or he could try to buy a big depressed home builder like D.R. Horton or Toll Brothers, now that key founders have died. Depressed PepsiCo, whose stock is at a 5-year low, might appeal to Buffett, but he's probably too loyal to Coca-Cola, a long-standing Berkshire equity holding, to consider buying rival Pepsi. Buffett is a value investor at heart and doesn't like to pay up for acquisitions. He has a lot of competition from alternative asset managers with mandates to invest and a willingness to pay more than Buffett. Expect other questions about the company's rail unit, Burlington Northern Santa Fe, which has some of the industry's worst profit margins. Another likely topic is Berkshire Hathaway Energy, one of the country's biggest electric utilities and a large operator of wind power and other renewable energy sources. And then there's auto insurer Geico, the most important part of Berkshire's huge insurance business. Geico has staged a financial revival and upgraded antiquated technology under the leadership of Combs during the past 5 years, but the company has shed about 15% of its auto policies to boost its profitability, while its arch-rival Progressive has expanded rapidly and blown past Geico to become number 2 in the industry behind State Farm. Some investors worry that Geico will permanently lag behind the innovative Progressive in technology, including the use of telematics, or real-time driving information, to price policies. But no matter the questions, or whether the answers are to their liking, Berkshire investors are likely to savor the moment in Omaha. It may be one of their last chances to marvel at the Oracle of Omaha, bathe in his aura, and be thankful for 60 years of investing done right. The next headline in the Barrons of April 28th, energy has been hit hard. Chevron can bounce back. Concerns about the oil major have led to an overly bearish outlook and an opportunity for investors, by Teresa Rivas. Energy's been tough to invest in lately, but as one of the biggest companies in the game with plenty of cash on hand, Chevron looks relatively safe. Chevron shares have gotten too cheap considering the company's earnings potential and defensive characteristics, which include its tariff-resistant U.S. energy-producing assets. The company's generous dividend looks safe as well. When the going gets tough, the tough go big. There have been few places tougher to invest in during the current market chaos than energy, but big oil, particularly Chevron, deserves investor attention. Chevron, like many of its peers, has been beaten down on worries about the tariff-induced trade war and a potential increase in production from the organization of the petroleum exporting countries that could hurt the price of oil. Yet the biggest energy companies are sitting on piles of cash and global portfolios that help mitigate risk. Chevron specifically has gotten too cheap, trading at a 10% discount to its 5-year average forward price-to-earnings ratio, even as analysts expect earnings to bottom out in 2025 and rebound strongly over the next 3 years. It also makes a nice place for investors to hide. Big oil has held up better because they produce oil and gas, refine oil and gas, and then they retail oil and gas, says Bill Smead, Chairman and Chief Investment Officer at Smead Capital Management, who follows energy markets but doesn't currently own Chevron. They're downstream, midstream, and upstream types of companies. Therefore, they're more of an energy staple than just pure producers. They're the widow and orphan stocks of energy. They also have enough money on hand to snap up struggling smaller companies on the cheap that could be accretive long term. It's true that the energy trade to some degree will depend on the trajectory of oil prices, and those have been falling on concerns that a slowdown in the U.S., or the world, as a result of tariffs will hurt demand just as OPEC plans to lift some production quotas. Yet, energy stocks and oil have already priced in a recession, argues Roth Capital Partners chief economist Michael Darda. He remains a long-term bull, noting that the energy sector is the only sector with double-digit upside to normalized earnings estimates, and investors who made the painful decision to buy the stocks in 2008 and 2020 cleaned up in the years following. Chevron's earnings per share growth is expected to jump an average 15% a year over the next 3 years to $13.46, while its 5% dividend looks safe, given a strong balance sheet. The company's operations around the world make it less vulnerable to upheaval in various regions, while in the U.S. it's now sustainably producing over 1 million barrels a day in the Permian Basin. And while it probably won't be big enough to move the needle near term, Chevron is aiming to tap into new markets, including its announcement earlier this year that it's looking to help meet growing data center energy demand. Ben Cook, who serves as portfolio manager for 2 of Hennessy's energy funds, notes that even with oil down, Chevron's cash profits, it's expected to throw off nearly $21 billion in free cash flow this year, is very strong. Even at $50 a barrel, we're still looking at a company capable of generating something on the order of 5% on a free cash basis to enterprise value. That should provide some comfort that even down to $50, you have an asset that's generating free cash. It's a name we'd be looking to add to in the current environment. West Texas Intermediate crude was recently trading at $63.25 a barrel, down 12% this year. Cook likes that Chevron is finally getting to see some fruits from investments made in its upstream assets in recent years, like its TCO joint venture in Kazakhstan, and that its seasoned management team has been able to navigate through various economic cycles. Of course, there are legitimate concerns about Chevron, even beyond potential trade war fallout and OPEC output hikes. The company is still planning to close its Hess acquisition later this year, although it still has to iron out some details related to Hess's partnership with ExxonMobil in Guyana. Deteriorating relations between the U.S. and Venezuela have upended Chevron's projects in that energy-rich South American nation, after President Donald Trump said the company could no longer operate there amid his deportation push focused on Venezuelan migrants. Chevron's green energy projects in the U.S. could also get backburnered, given the administration's stance on climate change. Nonetheless, with Chevron recently trading down to levels it hasn't touched since the last bear market, the outlook may have simply gotten too bearish. Gerdes Energy Research's John Gerdes recently upgraded Chevron to buy from neutral and has a $167 price target, up 20% from Friday's close of $138.73. Chevron's cash operating margin is approximately 20% above the industry median, and the company's capital intensity is about 15% below the industry median, he writes, noting that puts it in the top decile of energy producers in terms of returns through a full cycle. In a bullish scenario, the shares could trade above $200. That may be unlikely in the near term, but the point remains energy has gotten hammered so much harder than the broader market that fear has crowded out fundamentals, with a worst-case scenario already priced into the beaten-down stocks. When equities like Chevron reflect a lot of risk, that represents opportune times to get exposure, says Cook. For us, it's a comfortable place to hang out while markets remain volatile. We could all use a little comfort these days. Next, in the Barrons of April 28th, under stress, munis still look strong. Threats to tax exemptions and tariff turbulence have hit municipal bonds hard, but the market remains healthy, by Amy Stone. Things have gotten crazy in the normally staid world of municipal bonds. Concern that munis might lose their crucial tax-exempt status as part of the budget process has been an unpleasant backdrop all year for investors. And then came President Donald Trump's Liberation Day tariff announcements, which rocked global markets and sideswiped munis. At first, yields fell as investors saw munis as potential havens. Bond yields move inversely to prices. But they quickly shot higher as Treasury yields soared on fears about U.S. stability. Stocks plummeted, and investors dumped an array of bonds, including munis, traditional favorites of wealthy investors. Muni exchange-traded funds, which have 3 times the assets they did during the pandemic, added to the frenzy with heavy selling to meet redemptions. At the same time, tax season selling was heating up ahead of April 15th, and muni issuers were rushing to get deals done ahead of any potential tax policy changes, says Pat Haskell, head of the municipal bond group at BlackRock. Those dynamics created adverse price actions, he says, but also opportunities. The $38 billion iShares National Muni Bond ETF, ticker MUB, which tracks a muni index, is down 2.5% year-to-date. Most of that lost in the past few weeks. The yield on Bloomberg's 10-year AAA Muni Index jumped from 2.94% on April 4th to a high of 3.8% by April 9th. It remains around 3.5% for a tax-equivalent yield of nearly 6% for investors in high-tax brackets. Muni bonds are often issued by public state and local bodies to finance operations. Long-term munis are especially appealing based on an after-tax comparison with treasuries. Yields on the 30-year muni index are now about 95% of those on 30-year treasuries. That means you get the benefits of tax exemption practically for free, says Lyle Fitterer, co-manager of Baird Strategic Municipal Bond Investor Fund, BSNSX, the ticker symbol, which earns 5 stars from Morningstar. For 10-year munis, the ratio is 80%, so essentially anyone in a tax bracket higher than 20% would benefit from owning munis over treasuries. You can generate a tax-equivalent yield of 6 to 8% in a high-quality asset class, Fitterer says. That's pretty attractive. One reason yields are still elevated is because risks remain. Global markets continue to swing wildly based on fluctuating tariff policy, and Congress has hard work ahead to pass a tax package that will include cuts to offset some of the cost of extending Trump's 2017 tax cuts. Removing tax exemption from muni bonds has been floated as a way to pay for those tax cuts. Interest on muni bonds has long been exempt from federal taxes, and in some cases from state and local taxes. Tom Kozlik, head of municipal strategy at Hilltop Securities, put that risk, that munis would lose tax exemption, as high as 50% earlier this year. But in early April, the House of Representatives passed a budget framework that targeted $1.5 trillion in spending cuts, down from the $4 to $10 trillion expected earlier. Now he sees a 10% chance of the muni exemption being revoked, although he still believes the budget bill could include smaller changes to municipal bond tax exemption affecting specific sectors. He isn't alone. We continue to believe that if there were any changes, they would likely affect the private activity bonds issued for things like private universities, airports, and stadiums, says Margot Kleinman, head of municipal credit research at Nuveen. Budget cuts could also hurt muni sectors. Medicaid cuts could have a big impact on hospital bonds, which make up about 9% of the muni index. Craig Brandon, part of the Morgan Stanley team that manages the Eaton Vance National Municipal Income Fund, trading as EIHMX, a 4-star Morningstar fund, says budget processes can net surprising results in the 11th hour. I've learned you never say never, he says. The impact of tariff policy is an overhang on muni prices, even though municipalities aren't directly affected by tariffs. States that derive revenue from agriculture might suffer from tariffs. Bonds to fund infrastructure projects for transportation or housing could be affected by higher materials and labor costs. BlackRock suggests in its April Muni report that investors underweight small private colleges, hospitals that serve a lot of Medicaid patients, senior living, and long-term care facilities, and any speculative projects with weak sponsorship, unproven technology, or unsound feasibility studies. That sounds like a wide net, but it actually leaves the bulk of the muni market looking quite strong. Moody's Ratings gives 19 states AAA grades, 28 AA grades, and only New Jersey and Illinois get single A. Wyoming isn't ranked. Maryland alone has a negative outlook, while the rest have positive or stable outlooks. Plus, municipalities can raise taxes and fees if they need to, points out Jennifer Johnston, Director of Muni Bond Research for Franklin Templeton. It's a great time to take advantage of some of those higher rates that are suddenly available, she says. The Franklin Dynamic Municipal Bond, ETF, trading under FLMI, gets 4 stars from Morningstar and has a 4.14% current yield. Diversification and active management from firms with muni research teams makes sense, given the intricacies of how policy changes can affect individual bonds. Investors in high-tax states may want to consider single-state funds for an added tax benefit. The bulk of issuers are providing essential services, so they do tend to be very resilient, says Kleinman. She says her team uses bottom-up credit analysis to find opportunities, even among lower-rated bonds. Nuveen High Yield Municipal Bond Fund, trading as NHMRX, reflects that strategy. It has a trailing 12-month yield of 5.2%. For investors who want less interest rate risk, Nuveen Short Duration High Yield Municipal Bond Fund, NVHIX is their ticker, is an option. Its trailing yield is 4.74%. The opportunity might not last that long, says Jeff Timlin, portfolio manager for tax-exempt fixed income strategies at Sage Advisory in Austin, Texas. With munis, you can get into what he calls a negative feedback loop, where negative returns lead to a liquidity crunch that begets more selling. But it does stop when valuations become so attractive that buyers start to come in. Then it's amazing how quickly things turn around. The next headline, Gold is beating everything. How to get a piece of the action. Gold is on a historic run, fueled by uncertainty and buying by central banks and individuals. How it fits in a portfolio by Jack Huff. Give gold bugs their due. The yellow metal has been a light in the investing darkness. At a recent $3,349 per troy ounce, it's up 27% this year, to the envy of stock, bond, and Bitcoin holders. Cash flow purists will call this a flash in the pan, but they should look again. Over the past 20 years, SPDR Gold Shares, an exchange-traded fund, has surged 610%, 21 points more than SPDR S&P 500, which tracks shares of the biggest U.S. companies. That isn't supposed to happen. If businesses couldn't be expected to outperform an unthinking metal over decades, shareholders would demand that they cease operations and hoard bullion instead. So what's going on? If this were gasoline, or Nike shoes, or NVIDIA chips, we would look to supply versus demand. With immutable gold, nearly every ounce that's ever been found is still around somewhere. So price action is mostly about demand. That's been ravenous and broad since 2022. That year, the U.S. and dozens of allies placed sweeping sanctions on Russia, including its largest banks, and China went on a bullion spree. Its buying has since cooled, but other central banks have stepped in. Perhaps this is unsurprising in light of a decades-long diversification by finance ministers away from the U.S. dollar, which is down to 57% of foreign reserves from over 70% in 2000. But the recent uptick in gold stockpiling looks to J.P. Morgan Chase, the world's largest bullion dealer, like a debasement trade. Investors are nervous about President Donald Trump's tariffs, his browbeating of the Federal Reserve Chairman over interest rates, and blowout U.S. deficits. It isn't just bankers. Demand among individuals for gold bars and coins has been surging. Some dealers experiencing sporadic shortages. Gold ETFs were bucking the trend, but flows here have turned solidly positive since last summer, including recently in China. All told, there's now an estimated $4 trillion worth of gold held by central banks and $5 trillion by private investors. Calculated against $260 trillion for all financial assets, including stocks, bonds, cash, and alternatives, that works out to a global gold portfolio allocation of 3.5%. That's a record. So what's next? B of A Securities says that central banks have room for much more gold buying, and that China's insurance companies are likely to dabble too. RBC Capital Markets analyst Chris Looney says ETFs could drive demand growth from here, especially if angst reigns. Gold is that asset of last resort, the part of the investing universe that investors really look for when they have a lot of questions elsewhere, he says. Russ Kesterich, a portfolio manager for BlackRock, a major player in ETFs, including the iShares Gold Trust, says that gold has proven itself as a store of value and deserves a 2 to 4% weighting for most investors. I think it's a tough call to say, would you chase it here, he says. There have been some pullbacks. Those might represent a good opportunity, particularly for people who don't have any exposure. Daniel Major, who covers materials stocks for UBS, points out that gold miners mostly haven't wrapped themselves in glory in recent years with their deal-making and asset management. As a result, a major index for the group is trading 30% below pre-COVID levels relative to earnings. UBS increased its 2026 gold price target by 23% to $3,500 per troy ounce before gold's latest lurch higher. Many miners are producing at a cost of $1,200 to $2,000. Major has bumped up earnings estimates across his coverage. I think we're going to see further upward revisions to consensus earnings, he says. This is what's attractive about the gold space right now. Major's favorite gold stocks are Barrick Gold, Newmont, and Endeavour Mining. More on those in a moment. We also have thoughts on how not to buy gold and what not to expect it to do. Don't count on it to keep beating stocks long term or to provide precise short-term protection from inflation spikes and stock swoons. But first, a little history, chemistry, and rules of the yellow brick road. Flesh of the gods. The first gold coins of reliable weight and purity featured a lion and bull stamped on the face, and they were minted at the order of King Croesus of Lydia in modern-day Turkey around 550 BC. But by then, gold had been used as a show of riches for thousands of years. Ancient Egyptians called gold the flesh of the gods and laid the boy king Tutankhamun to rest in a gold coffin weighing 243 pounds. The Old Testament says that under King Solomon, gold in Jerusalem was as common as stone. Allow for literary license. Silicon, an element in most stones, is 28.2% of the Earth's crust, whereas gold is 0.0000004%. Marco Polo described palace walls in China covered with gold. Mansa Musa I of Mali in West Africa, on a pilgrimage to Mecca in 1324, is said to have splashed so much gold around Cairo on the way that he crashed the local price by 20%, and it took 12 years to recover. To Montezuma, the Aztec king whose gold lured Cortez from Spain, the metal was called, as it still is by some in central Mexico, Teocuitlatl, literally God excrement. Golden eras, gold medals, the golden rule, and golden calf. So deep is the historical association between gold and wealth, excellence and vice, that it seems to have a mystical hold on humanity. In fact, it's more a matter of chemical inevitability. Trade and savings are easier with money. Pick one for the job from the 118 known elements. Years ago on NPR, Columbia University chemist Sanat Kumar used a process of elimination. Best to avoid elements that are cumbersome gases or liquids at room temperature. Stay away from the highly reactive columns 1 and 2 on the periodic table. Can't have lithium ducats bursting into flame. Money should be rare, unlike zinc, which pennies are made from, but not too rare, unlike iridium, used for aircraft spark plugs. It shouldn't be poisonous like arsenic or radioactive like radium. That rules out more elements than you might think. Of the handful that are left, eliminate any that weren't discovered until recent centuries or whose melting points were too high for early furnaces. That leaves silver and gold. Silver tarnishes, but rarer, noble gold holds its luster. It's malleable enough to pound into sheets so thin light will shine through, and despite the best efforts of Isaac Newton and other would-be alchemists, it cannot be artificially created. Profitably, anyhow. Technically, there is something called nuclear transmutation. If you can free a proton from Mercury's nucleus or insert one into platinum's, you'll end up with a nucleus with 79 protons, and that's gold. Scientists did that more than 80 years ago using mercury in a particle accelerator. But what little gold they produced was radioactive. If you think you can do better, you'll likely need a nuclear reactor to prove it. But a large gold mine is 1/5 the cost, and we have to believe the permitting is easier. We passed over copper due to commonness, but it has become too valuable to use for pennies. The 95% copper content of a pre-1982 penny is about 3 cents today. The equivalent amount of silver goes for $3.15, and gold more than $315. But the three trade in different units. A pound of copper is up 20% this year at $4.85. Silver and gold are typically quoted per troy ounce, a measure of hazy origin and clear tediousness, which is 9.7% heavier than a regular ounce. A troy ounce of silver is $33.58, up 16% this year. Confused? This won't help. The purity of investment gold, called its fineness, is measured in either parts per thousand on a 24-point carat scale. A carat with a K is different from a carat with a C, which is the gemstone weight. But our friends in the UK who adopted troy ounces in the 15th century often spell both words with a C. Gold bricks, like the ones central banks swap, are called good delivery bars and weigh 400 troy ounces, give or take, worth more than 1.3 million. If you buy a few, lift with your legs. Each weighs a little over 27 regular pounds, as opposed to troy pounds, which, it pains us to note, are 12 troy ounces, not 16. Oh. There are many options for smaller players, like Canadian maple leaf coins, which are 24-karat gold, South African Krugerrands at 22 carats and alloyed with copper for durability, and gold American Eagles, 22 carats with some silver and copper. Proof coins cost extra for their high polish, artistry, and limited runs, and may or may not become collectibles. Humbler-looking bullion coins are bought for their metal value. Prefer the latter if you aren't a coin hobbyist. Avoid infomercials and stick with high-volume dealers. Surging demand. It isn't just bankers. Demand among individuals for gold bars and coins has been surging, with some dealers experiencing sporadic shortages. Gold ETFs were bucking the trend, but flows there have turned solidly positive since last summer, including recently in China. All told, there's now an estimated $4 trillion worth of gold held by central banks and $5 trillion by private investors. Calculated against $260 trillion for all financial assets, including stocks, bonds, cash, and alternatives, that works out to a global gold portfolio allocation of 3.5%, a record. And with that, we've come to the end of our reading of Barrons magazine for the issue date of April 28th of 2025. This is your reader, Eric, saying be well, be safe, look after each other, and remember our veterans, especially those we've lost recently. Bye for now.